Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, November 6, 2025. It is 9:56 a.m. Eastern Time. I'm starting the video, so we're a half hour into the trading day. And here's what I want to do in this one. Quick update on a couple of the commodities that I like, both near and long term. And those are, by the way, they're standalone trade ideas, but they're also, I guess somebody asked me fairly recently, where to hide. Let's just say I'm right, and the market's going to take it on the chin through the remainder of the year and well into next and possibly beyond. And again, what you want to look for, I do believe, and I'm going to get into this in the latter part of the video, the correlation between all these risk on assets, and the fact one going down, Bitcoin's been going down quite a bit. I'll get to that. Will ultimately spill over into everything else because it's generally, not being literal, but generally the same group of folks that are on margin leverage. I've covered that. We're at record high levels on margin interest from brokers. That means the great unwind is going to be a beautiful, beautiful thing when it comes. It is not a matter of if it comes. I've covered that chart. Maybe I'll get to it in this video. I wasn't planning to it in case you hadn't seen it, but I've covered that recently. And again, it's selling will beget more selling. Fundamentals won't really matter. And ultimately, my theory, right or wrong, is that the simple fact that we're going to enter a pretty damn vicious, ultimately, bear market in risk on assets, which are equities, crypto, and the high flyers, will then, if nothing else, if we don't have any other shoes dropped, credit markets, like I've talked about, I think, and that's all interrelated. So again, simply the equity markets themselves, if they happen to collapse on their own weight, again, if there's no other catalyst and it's just kind of markets start going down and then building some momentum. Like I said recently, it's not a 5-10% drop. That's not going to do anything really much to consumer spending. But once you get much below that, 20, 25, 30, you will then see a vicious cycle, if you will, or a positive feedback loop, really, that consumer spending, especially on the top end consumer, will go down, which we've already seen the low end buckle. And then again, it just spills its way throughout everything else, and ultimately including the AI hype, AI bubble. Alphabet, Meta, they're all, making Amazon good money to support the CapEx they're plowing into AI. And if you think that you're not going to see a certain percent of people cancel those Chat GPT premium subscriptions and Perplexity and all that other stuff, that right now, again, the revenues are just dwarfed by their spending. But again, it's a vicious cycle. So let's go over the charts, and I'm going to start here. And you may not share my views on the longer term outlook on the market, but this is a trade I've been harping on for a long time, and it kind of reminds me of the my calls on the stock market, where wheat, I've been looking for a major bottom for over a year now, right? Because we've come up on, I've covered this chart dozens and dozens of times over the last couple of years. And this is my primary secular bull market uptrend line, comes all the way back to back in the year 2000. So we're talking a quarter century uptrend line. And we're starting to finally go. We've had a few spurts off that trend line again, so nothing to get excited about. But just like the equity markets, as long as the technicals point to one direction, especially bigger moves, please understand, when I'm covering 15-minute charts, that's the realm of the active trader. That's near-term stuff. When I put up a trade, like the recent QQQ trade, based on a 15-minute chart, I'm looking out days to weeks, right? However, on QQQ, I trade, like a lot of things, multiple time frames. So I have covered the weekly and daily. Those haven't changed. They don't change very frequently, especially the weekly charts, and even more so the monthly charts. So this is a long-term chart. But again, I've been on the 60-minute charts for over a year now, just pointing out these little divergent lows off this long-term trend line. And my targets, as you can see, are ultimately, I see no reason why especially in still the coming off the one of the biggest hottest inflationary environments in really since the mid 70s, early to mid 70s. Why we can't get back up there again where it was last couple times in that quarter century run. And so that's it. And like guys, like everything else, it either pans out or not. So I get the vast majority of the comments on the site are on the equity markets, and I get it because I cover the equity markets more than anything. Because at any point in time, I'm going to cover those day in, day out, week in, week out. That's it. So I just wanted to point out that in case you're new to the site, I've covered this many times. This is where we've bought wheat before here on this downtrend line. We've caught these runs. We've also shorted it off some of these divergent highs and these trend line breaks and things like that. And wheat, every so often, she has a tendency to go parabolic. And that's why I like to trade it. Now, we also have sister trades in corn and soybeans to kind of spread the bets. Sometimes one will outperform the other. They all tend to move together. So again, when I say sister bets, they're highly correlated. That is no different at all from being long the VIX and short the stock market via either SPY, QQQ, IWM. Same kind of thing. Even though those are two different directional trades, they're extremely highly correlated with other. You're not going to make a decent amount of money on the VIX without a correction in the stock market. All right, so that's it. And we're starting to move away from it. And so, again, just like we had the potential back here and here, and it's a long-term trade, so I will almost certainly be adding additional targets to those 60-minute charts and daily charts of WEAT, the wheat ETN. The other one, which I still like long-term, and it's been a trade for a while now, is Nat Gas. Let's look at my weekly chart here. This was just a monster trade. I was happy with myself for milking out every penny that I could see out of this last trend. We went long the lows in 2024. I gave initial targets, and then early on in that trade, I extended targets to give a final price target of $4.90, which was hit to the exact penny on a Sunday evening trading, and I even got a post out to you that night, reversed it. And when I did that, when I reversed it, I gave you a pullback target now of an uptrend line off the lows. And I will say one time, if you go back, if you have any questions, I can dig them up, give you the chart that I had tweaked this uptrend line ever so slightly. But when we hit it recently, even a few months back, that's when I started getting both near-term and longer-term bullish, just like wheat, kind of sniffing out those 60-minute divergent lows. We're in on one now, and then I gave you back all the way back then, last year or even in 2024, I gave you a potential longer-term target that, and I, for all the reasons there, didn't just close that trade out. It's $4.90. I reversed it, posting that, and so that's still a longer term target. So what you're looking at here, and guys, this is where, as a swing or trend trader, again, you define the trends. You know me, I like to go long, short, long, short. I like to milk if possible, when possible, the counter trend moves within a bigger trend. So this is still a longer term price target that I still maintain on natural gas. It's still well above those lows from 2024. And again, it was very constructive, just like wheat, just like the stock market in reverse. You have positive divergence here in the stock market, just like natural gas here. You had negative divergence. And those are when you're dealing on a weekly time frame. Oh, I'm so sorry. I realized what I just did. I squished the chart. You were looking at, you couldn't see everything on there. So again, nat gas. Let me just move that up here so you can see the years down below. And that's it. And like any trade, it either works out or it doesn't. That's what stops are for, my friends. But so far, we're coming off there, and we already had that check. That was the trend line I saw us going back to for the next leg up. And to try to quantify it for you, if hit, again, there's a big if. Let me just put the crosshairs up from the pullback to the trend line, which is about where we went low recently, right off the bullish falling wedge breakout. We're talking a move of, if you can see it just all the way to the left of the screen, shows the percentage. That's about 135% run if we hit my next target, which is about 6 to 640-ish. Again, big if, but spread your bets. Take trades that align with your trading style. When you trade natural gas, I call her the widowmaker. You're going to have to use larger than normal stops, or you're just going to get clipped out in the day-to-day noise of volatility. And we're still there's no update on that trade shorter term. We're going to look at the this level here, waiting to see T1 pop right here. T1 was already hit once, hit again. And so once we pop that should get us going up to these next 60-minute targets. And then again, I'll turn my focus to the longer term charts. And when it looks like there's going to be a good counter trend pullback, I'll let you know if I can see that and try to game that. But as of now, like I said, we've already been checked off T1 twice. I'm just ready. I think it's ready to pop. Looks like that way to me, especially if crude continues to fall right now. Again, I talked on that yesterday. The charts aren't very clear, but barring any other geopolitical events or anything else like that, we should see, especially if the stock market continues lower in the near term, to hit my near-term targets on QQQ, the next downside targets. That should most likely give some concerns of demand destruction. We know that 10% of the flights have been canceled by the current administration due to the government shutdown. I can't imagine that helps, energy prices, fuel prices, fewer planes flying. But again, that's fundamental stuff. We'll go by the charts. As long as we're on stock charts, let me share something with you. I don't share this one often. Every now and then I'll go in. I'll sometimes do videos on breadth indicators. But I have one that I created years ago, many years ago, well over a decade ago. It's a custom indicator. Now, I didn't invent the Hindenburg omen. Some of you may have heard of that if you've been around for a while. You don't hear much about it anymore. It was a big thing back in the, in the early 2000s. And it had a pretty decent track record. Basically, it's a breadth indicator. Somebody, whoever it was, came up with that based on the NYSE. And so, as put my primary focus is on the NASDAQ 100. And again, I know it's not nearly as representative as of the entire U.S. stock market or the economy as the NYSE or the S&P 500 or the Wilshire 5000, but it is overweighted in the same stocks that move those indexes. They have the highest weighting, the big tech stocks. And so years ago, I came up with this, and I just took all the criteria from the Hindenburg omen, which you can Google and find out what they are, and they're all here, and I wrote them down, except I transcribed everything over to the NASDAQ instead of the NYSE. And so, and it's worked actually. I've covered this in the past, and we've had some pretty nice corrections and bear markets in recent years if you use the old 20% definition to drop off the highs. And I just wanted to let you know that I've had it fire twice recently. This was a trigger right here. So basically, you can see the criteria, but in this case, right here, the McClellan oscillator is negatives. You have to have that. And that's this red up top. Here, let me just right here. The daily number of new 52-week highs and the daily number of new 52-week lows are both greater than or equal to 2.8 of the sum of the NASDAQ issues that advanced or declined that day. So that shows you quirky things going on in the market. You don't usually see that. Usually when you get a high spike of the 52-week new highs, your 52-week lows are very low. But as I've talked about here, breadth in this market just sucks. And again, it's the same story it's been for a while. And people are now, I'm hearing these analysts or pundits that shouldn't even warrant any time in the media or on air, come out and say, oh, well, it's okay now that just the handful, 3 or 4 companies are driving the entire stock market and the economy. I told you I read recently, and I was surprised to see that AI spending has actually accounted for more than consumer spending to the most recent quarter of GDP, which is scary. And if you think that's healthy or sustainable, then I suggest you find another service and cancel that, because our mindsets are so different. That's fundamental stuff, guys, by the way. It can continue for a while. and for quite some time. The old saying is the market can stay irrational longer than you can stay solvent. But again, from such extremes come extreme moves on the other side. And so, yeah, and maybe I'll be singing this same song 6 months from now. I really doubt a year from now. But until those unusual and extreme conditions rectify themselves, and again, from that, when you have such extremes in the market or whatever conditions, a bubble, in history, you don't just level out and then resume. Bubbles usually end, they start going parabolic or near vertical at the end, and then they come down, crashing down. So, all right, guys, I just wanted to say that it triggered recently. Here, let me just finish this. You can see the criteria. The NASDAQ needs to be going up higher than it was 50 days ago. We got all that check, check, check. Boom, there's one. You can see the red bars over here, right there. And boom, there was another one right there, another signal. And is that one as well right there? No. All right, so we had at least two firings on this. This is just a zoom in. These guys here, everything on the right, let me grab my tool, is a zoom in so you can see it clearly most recently. And I don't get a lot of these. So this is a market crash indicator. Take it for what it's worth, guys. I'm going to, it doesn't change a whole lot for me as far as positioning, because again, it's not, if you follow the Hindenburg or look it up, it's not a timing indicator. And the more the signals you get, so it's not you get one of those signals, you load up short. That's not how it works. The more signals you get in close proximity, the more likely you are that the signal is to pan out. And a market crash, you can define it however you want. It's not going to be Black Monday again. That'll never happen again because of circuit breakers. That was the big 20-something% drop in a single day in the S&P back in 1987. But circuit breakers will prevent us going down that much in one day. But we can still get, and the market will go when the time comes. If the charts say it's going to go from point A to point B, it's going to go to point A to point B, and they can only slow it down so much. And that's it. They can just slow the rate of ascent a little bit with circuit breakers. But let's move on here. All right, so that's it. Let's go to the regular charts now. QQQ. 15-minute chart. I did an in-depth coverage on this last night, so no reason to expand it more. Like I said, we shot over a whopping 0.3%, overshoot of my target. But like I said, it's Gap City. Right now, look, we just had another gap. See, I had added these recently, as I said in the comment, my reply to the comments. Yeah, there's a lot of gaps here. That's a minor one. This is where I think we start to accelerate down. This is a level. This will be the next target. That's it. So I acknowledge this gap. It's not a price target. And be honest with you, normally, I do bounce these gaps. I'm just going to sit tight right now, hold out for at least the T2 at this time before considering gaming any bounce. And even then, I'm going to look at the charts. I'm going to go through the charts of as many individual top stocks I can, other indexes. And there's a point when you're in a hot market, a lot of hot air, a lot of trap longs, that then you just start smashing through support levels like they're not even there. And that, my friends, is a good tell on the market to me. It tells where supply and demand is. It told me what's going on silver. That's why I reiterated that short entry today for you. If you're trading silver, this was a beautiful textbook bullish falling wedge. We gamed it, but I had two targets. I give you silver futures. That would have been that T2, which I then canceled on the futures. That was T1. And it just shows where are all the buyers. This was such a hot trade. People were tripping over each other. The people coming out on TV, I just couldn't believe. And these people, it's like, if you lived through enough cycles, they were salivating over silver. Oh, you just want to hold on, buy any dip. This is going a lot higher. And guys, it may. I could be wrong. They may be right. We may do this. But, that's what stops are for. So if you game the bounce or didn't game the bounce or whatever, if you shorted it here, have your stop. Here's a bunch of gaps you can trade. You can see all the resistance levels. This is the last one. Anything above that, yeah, the uptrend's probably going to resume. But this was a very hot trade, and it popped. And when you look at this was our original sell signal there, and we're not to my. I give you one sole target on the daily chart. So if you're not an active trader and you get frustrated that oh, God, Randy, you're long today, you're short, what's going on? That's it. I like to just gain little squiggles, but this has not changed. I have not updated that or modified that. If I do, I'll let you know. And the key is we may never hit it. So if you took the short, you can see a cluster of trades here. If they get above there, they're probably going to run it most likely. And so you should have a stop somewhat above there. You'll still make a little bit of money. No reason to turn a winning trade into a loser. So that's that. Let me go to, let's talk about what I call the everything bubble. Let me go to QQQ weekly chart. There's that bearish engulfing. Again, the week it's not young anymore, but there's plenty of time left on the clock for the bulls to undo this bearish engulfing candle. And again, I've said enough on these. People have said, that's it. Take it, trade it, don't trade it. Remember, this sell signal, the break of the trend line, the back test is still intact. So we'll see how the week finishes there. But there's that bearish engulfing right now. And again, I even gave it to you on the 15-minute chart. Showed you we need to close. I need to modify that. I told you that the high or the body of the candle was a little bit above 624.04, which is right about here, right about T1, give or take. Oh, and look, we do have a little divergence I'll draw right here. So who knows? They are buying this gap right now, and maybe they'll take it a little further. There's this 15-minute chart, but you got a little divergence right there. But from my experience, guys, this is you can look at the thin zone. This is a much, much more significant level. And so I kind of have, it's not a theory. It's just, again, from experience, when I have a solid target, a really well-watched support level, it's almost, I liken it to a black hole. You know how they say, the gravity on a black hole is so strong, even light can't escape. So if anything gets too close, to it, and that holds true with these kind of targets. Again, it's not always, it's just most of the time. Once you get close enough, you get sucked in. So the gravity will most likely pull QQQ down closer to that, or all the way down to that second target there around 612.63. And so this is a bounce. Again, it's a bounce exactly where they told you. It's not even just humans, it's machines, trading programs, but people too. Everybody's watching these gaps. Every single gap. Look at this. This was a gap I told we bought the other day to bounce it off. And you can see, and this was the gap we stopped at yesterday, right here, this gap. So they're just ping-ponging it off there, but all the while, they're ping-ponging it lower. This is a near-term downtrend. I covered that yesterday. Now we just made a new low, which keeps this near-term downtrend intact. Remember, this is intermediate and longer-term uptrend. This is a very near-term downtrend, and so far, it's very much intact. So in that whole everything bubble, the main asset classes obviously are stocks, but not the entire stock market, because I've showed you that half the stocks in the S&P 500 are still trading and have been for a long, long time below their 200-day moving averages, 50 days, wherever, at least the 200s. I know I haven't checked it in a little bit, but you have, tech, particularly anything AI related. So that's big tech, Alphabet, Amazon, Meta, and then anything, the semis that the haves. And there's, just like the U.S. economy and the consumer, there's the haves and haves not. I did that detailed video in the semiconductor sector yesterday. By the way, I haven't had a single alert fired today. I didn't set my 50-day moving average alerts yet. I got to do that. But the trend line alerts haven't fired off yet. So hence the support, the case for a little bounce off that gap I just showed you on QQQ before we go down. And then so NVIDIA, AMD has been running lately, Intel, we know, mainly due to U.S. government support, and all those are the beneficiaries. So that's the AI bubble. You have crypto, which is this Bitcoin and Ethereum, and then the crypto proxies. I'll get to those in 1 second here. And then even lately, I don't want to. I'm not going to try to force gold and silver into that category. It kind of felt that way recently, and when they were all going up in line with the market, it showed me the same people that are have been benefiting, on their 401ks and stuff in the market we're probably plowing into gold hand over fist and silver because again, it's this kind of market we're in. Chasing anything that's hot, no matter what it is, even if it's a meme stock with no earnings. But let me carry on. So from this chart, this is kind of one of the go-to ETFs, IBIT, clearly below the trend line, also below the 200 days, but it's bounced off that 56.36 target I've given you. These are all targets I laid out previously. I also watch very closely the actual crypto, and that's BTC. That's what you're looking at here. This is a 5-year chart, daily time frame. And you can see this was a big old divergent high back there, followed by a drop of about 78%. So just remember, the trends in crypto are just phenomenally profitable to trade long and short. That ended with a bullish falling wedge. You had first the minor trend line breakout right here. Beautiful little wedge. Positive divergence, aka DL, divergent low, right? Breakout one, and then the secondary trend line breakout back test. And that took us up and set up this trend, which again, on the actual crypto, you have to almost squint to see are we below it. But this is a big wedge. Crypto's been very weak. And if that continues, which is my guess, because again, it's tied into the that whole margin bubble now, and that was a kiss of death when Wall Street finally, Wall Street is greedy by nature. We all know that. I'm not, anybody who works there, no offense. I used to work on Wall Street, not up on Wall Street, but as a stockbroker. And, so it's in their nature. And, when crypto came out, it was this whole, thing, and it was all the crypto heads. And then obviously, what happened? They legitimized it by, coming out and with, first the little proxies like ETCG, then eventually coming out with SEC approving all the ETFs that I just showed you, like IBIT and futures contracts, everything else. So now it's mainstream. But that same thing now has allowed people to leverage up on margin. And so the same folks that are chock full of Bitcoin now, when the margin bubble reverses, same thing happens to their as does to their Nvidia, even gold and silver. If they were loaded up on that, selling then begets more selling. It's a trend that reverses the other way. Margin, remember, it's just creating money. So if you're wondering, like, okay, the Feds, they've been in quantitative tightening mode. Well, if you're wondering where all the liquidities come from, margin is you give your broker $1, they'll let you turn around and buy $4 of stocks or even a lot more in futures or things like that. And so you have just a lot of capital creation there. Private credit has been huge. And so there's been, the junk bond market, huge amount of debt issuance last year and this year. And so, again, that will at some point go the other way. To me, that's not some crazy theory I'm floating out there. It's just a matter of time. Again, you can study the charts. That's what I do all day long. Go back decades, look at overlay the FINRA margin debt with the stock market. Look at the tops, look how they tend to go parabolic, and then look at the unwind of what happens. So again, I have to say that because I know my targets are so aggressive that longer term. And how can that all happen? And Randy, yeah, maybe you're right. The stock market's going to have a correction, but Bitcoin will do well. And so again, my theory, right or wrong, is that they're all going to kind of tumble down together, and then we'll look at hopefully our natural gas or wheat, corn, soybeans, or whatever I find at the time will be doing well. So this is, even if you take it in closer, which I'll do for you right now, again, we're below there, we're below the trend line, and we do have some price. I'm going to put it up here. This should do the trick right here. We have a couple previous lows there. And so that should be lights out for crypto and the market. I'm going to put one other price level here in case you're interested in trading it right there. That's 89,000 is my next price target if and when that we take out the recent lows. And then remember, we're already below this trend line here. And I've given you some official trade ideas too. This one, MicroStrategy, due to my, the outlook on Bitcoin, it was a sell signal there on a break of the trend line, and with a secondary sell signal or add-on to come on a break at S1. And we're coming up on my first target now, and these are still the next targets. So that still gives you, well, if we hit T1, it's going to be about a 16-17% drop. T2 is going to be about, from the S1 level, 36, and then finally about a 61% drop if T3 is hit. These were the last trades on it. Give you, we shorted it here, I think, right after that trend line break. Hit my first, second. We're on the way to T3, but at that point in time, for all the reasons stated, not just cover all shorts, but go hard long. And I even gave this one too, or one of the ones is including crypto and Ethereum. I'm sorry, Bitcoin, Ethereum as long trade ideas. I think, what did we go long as well? Coinbase, was it? There's a bunch of these guys I track as proxies. And anyways, all those targets were hit, whatever that trade was. We went to the reverse that and took everything long. So yeah, you can see Coinbase. Look at that, nice support there, about 294 with the 200-day moving averages just below, and a lot of thin air down below that one. So again, if you see additional sell signals, I just gave you one support level on BTC, and the level that IT needs to take out is that recent first target that was hit 56.36. I'm going to set a price alert there. At that point, it'll be pretty clear to the masses that we're below trend, and that should bring in the next drop. And it will almost certainly, in my opinion, coincide with a drop in the stock market. There's the one that's the one we reversed here. And I gave you 3 targets off the April lows, going along Riot, nice breakout there. And this one's come full circle. That's it. These are my kind of patterns. I get long and bullish when everyone else is bearish and scared and selling. And I see, beautiful setups like this. And then this has been just like the stock market rally, a lot longer in the tooth than I or just about anybody out there could have predicted for various factors. But it doesn't matter. That's what's happened. And I could care two flips that I didn't stay long the whole thing. In hindsight, do I wish I would have? Sure. But, it was, I'm happy to make a quick, whatever that is. I forget how much. I sold at T2, but T3, that was a fun target, 61%. That's swing trading. I like to sometimes catch the turns. Occasionally, like that natural gas trade I showed you in the beginning of the video, I'll capture the bulk of a much larger trend. But I'm happy for this. And this is a divergent high, breakdown back test below the wedge right there, with coming up on the longer term trend line. They'll most likely buy it here if and when that trend line goes, which I suspect it will. We're coming down to 1466. So from where we're at now, bounce or no bounce off that trend line, that's going to be a drop of about another 18% from where we're at now. And, the trends in this one are pretty big. We'll probably even go further than that. Divergent high, actually down to that divergent low, rally, divergent low, rally, divergent high. Let's see. Okay, and just to kind of wrap the video up, we'll look at, I have, as you probably know, if you follow me for a while, I have a gazillion watch lists. One of them is I call my TTW, things to watch. And in there I have a eclectic mix of various stocks, commodities, indexes, things that I use as a tell, if you will, on the stock market and the U.S. economy. Back in the old days, it was copper. Everyone used what we call Dr. Copper. They said had a PhD in predicting where the economy or in the stock market was going. That long since got taken back when China was sucking up copper to build out infrastructure, and it kind of distorted the market. So copper has long since been stripped of its PhD. By the way, we had a trade on that recently. I wonder if we need to reverse that. We took copper long exactly at the lows, hit my set. And there's another example of, that's fine. Got out at T2, milked it up. I took every penny of that one. Hopefully a lot of you guys did. And now it's come full circle. So that just reminds me that you can see now negative divergence, and copper is probably that uptrend, which we caught the very bottom of, is most likely now run its course with this most recent divergent high. And that's it. And there's a case where we went long literally at the low, the day of the low, without any positive divergence. So that's not a necessity for the reasons stated at the time. Again, it was a recent trade. You can go back and check that. But that's it. So this one's probably going down. All right, back to where I was. My things to watch list. In that is KMX, CarMax. They just 86 their CEO. Recognize higher loan losses. Their business is tanking right now. They're, as you guys, if you live in the States, one of the biggest car dealerships. And so Carvana will follow suit. Ultimately, that little house of cards will collapse. And you can see this one's down another 13%. And there's an example of a bear market. We took it here, hit the first target zone. It never made it up to any of these additional targets. But, there was a breakout on the wedge. And then, boom, this thing has just been, look at this. This is textbook bear market action. These gaps that just continue to plummet a stock. And at some point, we'll see the market doing something similar. It can't gap and won't gap as much as an individual stock. But I just want to show you what's going on in the real world. And again, CarMax, if you don't think that if you think their woes 100% unique, and Carvana, who's doing the same thing, kind of, pretty much, and there, Carvana looks like this. No, that just doesn't jive well. These guys are doing the same thing, selling used cars in the United States, car dealerships. Sure, Carvana does things a little bit different, but not at the end of the day, same thing. And so we're coming up. I've covered this recently. We shorted it right. I think it was right here. Yeah, I believe on that breakdown. We hit our first target. We danced on it for several weeks. Then we took it out. We've been dancing on the 200-day moving averages. This is still T2, but on this one, once the 200s go, there's a good shot because the T2 is now so close. Remember, when I gave you this trade, I didn't know when we would hit the 200s. So T2 was set there at horizontal price support. At this point, because we've danced on the 200s so long, once we lose the 200s, we're probably going to go down through T2, right? So I don't plan to cover T2, right? And T3 is just kind of May-ish support, and I'll most likely be adding additional targets to this stock because Carvana long-term, I think I already did. Didn't I give you some? Yeah, I did. I gave you Carvana. It's just like the stock market. It's really a call on a market that by a lot of metrics should have probably topped here. And I gave you long-term targets, and I still maintain those long-term targets on the stock market. Just like Carvana, the stock market made a marginal new and still divergent high. And again, as stated, and I have to repeat it because it's an important inflection point, cover all shorts and go full long, hard long on April 6th, and that's when Carvana and everything bottomed, which also coincided with price targets being hit on the stock market on this. So it's nothing more, as I've been saying, than just a reflexive bounce off from my first targets on the stock market on stocks like Carvana. And so these targets, this is just an extension of this. We shorted it up here originally, or when I can't remember when I gave you these weekly targets, but they're still very much in play. And I'm just trying to highlight how much more downside, if I'm correct on this, that's 81% from where we're at now, not from the highs, 81% from where we're at now. I forget where these targets were giving you, but about the same. It's about an 80% profit on this long-term swing trade, if hit. And like I did back here, I'll let you know if any of these, if there's a strong enough chance for a what I call a tradable bounce. We had a level hit a few minutes ago that I told you, I do these things in real time, that where I might normally have covered, I don't, but I gave you my thoughts that, the lemmings would buy because that's what they do, the dip buyers, and boom, we've already taken it out. So there was a quick bounce. By the time the ink dried on your trade, it reversed and you would have already been back to where you started. And now you're underwater because we've taken that level out and we're headed down to my second target. So there's an example of levels that I recognize as support, recognize a level of reactions likely, but just not enough meat on the bone for me to reverse, get out of my shorts and try to game that long bounce. So we'll see if that one pans out or not. All right, back to the things to watch. Let me just see if there's anything else that stands out. By the way, credit spreads, I didn't pull the chart. I pulled it the other day. Maybe I'll get to that. I've been ticking up lately. What else do I have for you? This one, I'll probably leave it here. I can do this with both ADP. Let's just go over to weekly chart. Let's look at, let's go to a monthly. Let's do this. Let's go to a monthly chart, turn everything off. And ADP has been around for a long time. And and this is what I've showed you before. And I've talked, and this is why we have such a potentially profitable shorting op right now with the government data in blackout mode, because we're flying behind and everybody, it's recency bias. They're assuming that just no news is good news on the economy. And again, the government has been criticized for years on things like inflation, the CPI, and how flawed their metrics are in understating inflation. Even the employment reports we know are subject to huge revisions. So, like I said, you want to kind of know what's going on in the job market. No better two companies than ADP and Paychex, the biggest payroll processors. And you can see, again, the white line I just put up is the S&P 500. This is ADP. We're going back as far as I can go. ADP came public in 84 right here, beginning of 84. And you can see it mirroring the S&P 500 perfectly. And again, not always. They're trading on different price scales. Remember, ADP is a stock. What you want to look at when you put up a comparison are where are they trending? Where do they inflect? And you can see perfect correlation there. Even so, when I go down here to weekly, what happened here, the stock market started correcting. Remember, it started long before the tariffs got put into effect. But ADP actually said, hey, everything's okay. We're still doing good, even though the market went down. So that was a tell, and I missed it, at the time. Again, covered at the lows, but just underestimated how far the market would go. However, this is where ADP said, we're done. That's it. Our business has peaked. Again, this is the efficient market theory that price says all known variables or stock are priced in. Those in the know. As I always said, insider trading, as the term you hear, is illegal, but it happens all the time. But there's also legal insider trading. That's from the insiders that are selling. All I can tell you definitively, without trying to be subjective guess, ADP is plunging. It's down 23%. It's gone completely the other way. So this is reflective of the job market. And the S&P 500 is ignoring that. And you don't see when there's disconnects, then you get a mean reversion. So in other words, stock market was correcting here in 2022, but ADP said, no, things are fine. And the market continued. Then we had this other correction in the stock market. ADP said, no, fine again. But this is the biggest divergence in the other direction that's saying, and again, I've covered this quite a bit. This is ADP on a daily chart. We've broken trend. So it's not just that it's gone down. You might say, it's a bull market correction, Randy. No, this is our primary uptrend line from the 2020 COVID lows. Big divergences. Each one had its own correction. Finally, the divergence panned out, and we took out, you can see here, both the primary uptrend line and the 200-day moving averages. Paycheck. And if you think, okay, well, Randy, you know what? ADP might have its own internal problems that don't have anything to do with the job market. You can look at Paychex as well. And Paychex also, and I'm not going to waste your time because I've done it. I'll just tell you, it also perfectly mirrors the S&P 500 with those rare exceptions of divergences. So there's our primary uptrend line off the 2020 lows. There's our big divergent high. There's the break of the trend line right here. And this thing has been just getting bludgeoned. So if the job market is holding up why is this stock down 30% with no signs of a bottom, no signs of a reversal? I would love to tell you I'd step in and buy it here. This is where I'll be a buyer right here, possibly from just maybe a bounce trade, 105.79. That's this really nice support. But right now we're below the 200s. We took out the trend line, and it all was telegraphed in the charts. And so those are very much of my things to watch list. As are, I'll just click on a few more. Auto dealerships, again, good luck CarMax trying to hold near those highs. So that's one of my favorite long-term shorts, CarMax. Divergent high, dealerships are plummeting. XRT retail stocks, T1's been hit. We're headed down to T2. Again, you want an idea of how the consumer's holding up. Look at the retail sector. And this is where I have it going. Remember, this was our truncated April 6 lows. We hit my third target. Like I said, it's a continuation trade. We hit 1, 2, 3. We shorted this one up, I guess, on that break right there. And then this was time for the reasons stated. Cover all shorts, go full long. And it's carried up quite a bit. But then we had this beautiful bearish rising wedge breakdown. First target zone's then taken out. We're on the 200. We just took out the 200 exponential. 200 simple moving average. Once that goes, they'll come down to T2, 3, 4, and then we'll know that the consumer has buckled. And no matter how much Daddy Warbucks spends, the high-end consumer, the billionaires and multi-millionaires, they can only offset the have-nots so much. Treasury yields, I've already, we've been short treasuries, broke out. TNX's yields going up. Just kind of another view, and I know I'm just kind of covering a lot of, told you it would be an eclectic mix of things today. This is where the Fed lost control of the yield curve back here on the 30-year bond. This is when they started their rate cutting cycle a year ago. Cut rates. This is the 30-year bond. Rates went nowhere but up. They cut again. Rates went up again. Had a little correction. And they cut one more time, and rates continue to go up. This time around, they cut right here on this line, September 17th. And I just wanted to point out that although we had an initial spike, a little abatement, again, we shorted treasuries, which means we were betting yields to go up. And that's what's happened so far. So I just wanted to point out, again, what good are these rate cuts doing? The Fed has lost control of the yield curve. And I will reiterate what I always say. You, I, anybody any business does not get to borrow money at the federal funds rate. Banks, when in distress, can go to the federal and borrow money at overnight lending rate. So the federal fund rate, normal points in times when they cut it, it's going to bring down long-term rates, but that's not happening here. So this all plays into the fundamental outlook. And again, I don't know where this is going. I suspect in the coming years we're going higher in long-term rates for the reasons I stated. But right now, I just wanted to point out, near term, again, this is where rates were when Fed cut. And here's where we are today on the 30-year bond. That's in my things to watch list. That's why I cover that. Stocks, right on the line again. I covered this one yesterday in detail. 1, 2, 3 days testing the primary trend line. I am waiting for, it'd be nice if it happened in this video, but I got to wrap up. I'm at the 48-minute mark. We're probably going to get some of my alerts firing off today on those semis I covered yesterday, but guess what? QQQ is also coming up to this target here right now. In fact, let me cover and reverse some short positions right now. Take a little off the table here. Actually, let me sit tight. Pulled up NQ. Before I do anything, I always like to look at NQ. And I'm going to sit tight. I'm going to finish this video. Let me wrap it up, see what else I need to cover. I'll sit tight right now. I'm kind of threading the needle here. I may just lower stops and let it run for now and see if we can overshoot, go to that trend line. But I have to examine. I have to look at a lot more things. When I do this, I look at Apple, NVIDIA, Amazon, Microsoft, Alphabet, Broadcom, Meta, Tesla. I look at the S&P 500. All right, yeah. Let me wrap the video up. I got to get my head into this and decide whether I want to cover any shorts and/or reverse long for a bounce. But I've got to look at a lot more charts than just these two. All right, I'll wrap the video up, get it out to you. Again, nothing's changed longer term. We're sitting on the edge, so I'm more apt to sit tight because I just showed you the semis are just on the verge of breaking down. When they, if and when, more like when they buckle, then this market, at least for the near term, at least for a healthy correction, more downside. Again, I have additional targets on the near term charts on QQQ, and this is NQ. And then if and when we get down to those targets, like I said, that's going to change things or has the potential to on the longer term chart. So either way, we're coming up on the recent lows on NQ, and we're at that support level on QQQ where we're probably going to see some buyers step in here. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.